Hello everyone and welcome to a special week in markets. Normally I'm joined by one colleague from the investment team. Today I'm joined by two exceptional colleagues. We've got George Bell and we've got Paul Durrans, investment managers on the desk here at True Potential. Now it's been an unprecedented week in markets, so I thought it important that both George and Paul join us. Welcome both for you. Now we want to give you some colour on what we've been up to in the True Potential portfolios, let you know what we've been doing to manage your money. But I think it's important that we do summarise the backdrop for you, given the move we've seen in equity markets recently. We're recording this towards the end of the week, so we've obviously had the spike back in equity markets following the rollback, at least on a temporary basis, for tariffs. So Paul, let's go to you first. How would you summarise or characterise what we've seen in markets in the last couple of days?
Well, we've seen exceptional volatility, and it really stemmed from a week last Wednesday when we had Liberation Day, a highly anticipated event where Donald Trump would be announcing reciprocal tariffs, or expected to be reciprocal tariffs on various countries. The event was certainly didn't go as expected. These weren't reciprocal tariffs. These were tariffs that were calculated based on trade imbalances, much greater, therefore, the tariffs than the market expected. And as a result, we've had a sharp drawdown in global equity markets, but not only global equities, commodity markets. And more recently, we've seen an unwind in bond markets after initially providing diversification. Actually, the bond market is saying to Donald Trump, we don't like your policy. And actually,
so that's key. So I think everybody will know we've had that drawdown in equities. Then what we noticed after Monday was that bond yields stopped falling. Yeah. So this is the bond markets reacting adversely to a form of liquidity tightening. Yeah. That could be, say, large fund managers or large leverage players unwinding positions. So not just selling equities, but selling bonds. Exactly. And of course, we know from the Liz Truss regime that when bond yields move adversely, that is, they move higher, it's bad for overall financial conditions.
100%. And it's proved to be the circuit breaker for Donald Trump. And he's actually had to take note of what the bond market's doing. You know, his rhetoric is trying to get bond yields lower, completely the opposite. And so he's had to come out and pause with this 90-day tariff.
So again, this is where it's really interesting. We were seeing short-dated sovereign bond yields fall. So in the gilt market in the UK, 2-year yields were still going lower. Same in the US, but it was the longer-dated issues. Those yields were rising, and that's actually where it's sensitive for governments, isn't it? Because that's where they borrow. They borrow longer.
And it's also sensitive for mortgage holders.
Yeah, and of course, the UK is sort of an innocent bystander in this, but the gilt market wasn't immune from that, and we were seeing gilt yields rise as well yesterday.
Exactly.
So that's just a backdrop. We'll come back to you, Paul. Again, thank you for that. George, we know from the questions that we've had from clients at the start of the week that they're interested in what we've been doing in their portfolios. You and I have been very busy this week with working with advisors, bringing them up to speed about what we've been doing. So let's summarise for our clients what you and the team have been up to, not just recently, but also really since the start of the year, where you have been de-risking and providing more diversification in the True Potential portfolios.
Absolutely. Thanks, Kevin. So ahead of Liberation Day, if we look at the first quarter, essentially what we've been doing is exactly as you say, taking some risk down. One of the key areas we've done that is through our equity allocation. So our equity allocation is just under 58% now in balanced, which is about 3% below where we were in our highest point of last year. And it's essentially halved the overweight which we were running to equities relative to an equally weighted model. Most of that reduction came through the US. So we as an asset allocation committee moderated our view through the first quarter on the US market, given we were seeing earnings momentum start to moderate in terms of corporate profits. We were seeing very high valuations and a build of political risk. With some of that capital, a portion of that went to the European market. European equities were an area where we were seeing lower valuations and actually improving earnings momentum. And also a tailwind of government spending coming through predominantly through Germany as well, which was quite encouraging. And a lot of this move was really enacted by our managers. So some of the key managers which helped us achieve this shape within our portfolios were growth aligned, were UBS, were Pictet, and to some degree Close Brothers
So
as well.
George, this is the advanced diversification angle, isn't it? This is where the dynamic aspect for the portfolios, the fund managers themselves doing the de-risking for us.
Absolutely. It's important to remember within the portfolios, what you won't see is us throwing the allocations around day to day, week to week. What we're doing is we're building allocations to managers which we believe are going to deliver over the long term for our clients. But the managers which we've employed within your portfolios are all active. So they'll be adjusting their portfolios to the risks and to the opportunities. So they did help us de-risk our portfolios, and they were building allocations to diversifiers such as gold and also to fixed income theoretically where it is compared to 2022.
Absolutely.
Higher nominal yields, higher real yield, they should serve as a better diversifier, but we have seen some volatility within that asset class.
I'm going to come back to you, George, just on a couple of aspects there, particularly on Schroders, because I know you've been busy with that fund manager in particular. Paul, it's really important that we emphasise this isn't 2022. That was an inflation shock. This is more of a growth shock, and that's why we've seen global equities fall. And we were seeing global bond yields fall. So can we help our clients understand the differences between that inflation impulse and the growth shock we're seeing in markets? For instance, commodities is what stands out for me.
It is a growth shock, and if you look at commodity prices, what they've done this year, just look at oil prices, they're down at least 20% from the start of the year. Go back to 2022, you had energy prices going up. So very, very different environment.
Yep, so that's it. So we're seeing oil prices fall, which means petrol prices should fall. Wholesale gas prices are falling. Some of that's seasonal, but of course a lot of it's been driven just by the fears over demand slowing from growth. And one side effect from tariffs in the US is that we may see goods prices across the globe fall as goods which were perhaps destined from the Far East to go to US end up in Europe. So we're likely to see at least a cap on goods prices, and we won't see stronger goods prices there. So that's interesting. And we shouldn't forget that the world is still turning. So we saw some economic data today, Paul, which is highly relevant for the US in a normal environment, but unfortunately not so much in the current environment, and that would be US inflation.
Exactly. Aside from tariffs, this would actually be a good story for markets. We've had inflation come in today at 2.4%, down from 2.8%. This is headline CPI inflation, so this would be a 6-month low. If we look at core inflation, so excluding food and energy, that came in at 2.8%. So this would be the lowest reading since early 2021. And what we are seeing is that falling gasoline prices really feed into the inflation component, but also some of the stickier components such as shelter, that's also moderated a little bit over the month. So a good story, but it's in the background at the minute.
So disinflation was there, and perhaps if Donald Trump had moderated on the tariffs, then we would have seen the Federal Reserve being able to cut constructively in interest rates. So it's a shame that story there has been clouded somewhat. George, let's bring you back in, because when you talk about what the fund managers are doing, I also think it's important that you bring out what you and the team have been doing, and this is where we can speak about Schroders more and the actions you've been taking really through a lot of Q1, adding diversification to the portfolios by using Schroders.
Absolutely, yeah. I mean, one of the key changes we've made, not just through the quarter, but over the last 12 months, has been the addition to Schroders. We've more than doubled the allocation there in our balanced portfolio, and we accelerated that move through that first quarter. And the key reason is exactly as you say, Kevin. Schroders are a key diversifier to us within our portfolios for 3 reasons. They've got very low allocation to the US and more of a lean into markets such as the UK, such as Japan and Europe. These are cheaper markets in terms of the valuation which is placed on them. You've got a lot less in terms of fixed income. You've got more in gold and more in alternatives, which are real diversifiers to the fixed income and the equity market. When we do see pressures, particularly upside inflation risks and downside economic growth risks, but also just a manager with a very strong track record of selecting products within these markets. So the build of this, it aligns very much with our views as an asset allocation committee, and it builds in the appropriate level of diversification within our models as well. And if we look at the funding source for this move, key has been 7IM, but more recently we've made a small adjustment from Allianz, and what we can say is that's been exactly the right move for clients. If we look at the relative returns, Schroders are delivering very well in this environment.
So that's two aspects there which are very important. One is that the managers themselves have been taking down equities, and you mentioned US equities. The other is that you yourself had been funding a diversifier such as Schroders from some funds such as 7IM, but also then Allianz, and that further takes down the US equities weight, and that was all prior to Liberation Day.
Exactly.
I think it's also worth highlighting the starting valuation in the equity book at True Potential Portfolios was a lot cheaper than US indices, wasn't it? And it's also, we didn't have as much technology exposure as the market, as implied by market cap indices. So a much better starting point.
Great point. If we look at it, the equity book in isolation relative to a global index, we had about 10% less in the US as a starting point. So we had a much lower valuation, as you say there, Kevin.
So we're maintaining that valuation focus all the while focused on diversification. So that's all for this update. We know that you've been tuning in to the morning markets and have hopefully heard a lot from us on market views. What we want to emphasise today is that the team have been taking actions to de-risk the portfolios appropriately, to add diversification, really lean into advanced diversification, which we know works so well, particularly in these moments of high volatility. I'm grateful to Paul for providing some colour that the economy is still moving and that we are seeing this disinflation impulse continue. Grateful also to George for providing that colour on what the True Potential portfolio managers have been up to. So that's all for this week. Please do like and subscribe on the YouTube channel. Please, of course, get in touch with your financial advisor or give us a call if you'd like any updates on what's going on in markets. I know the team are ready to answer your questions. And please do dial in on Monday for your look ahead. Thank you very much.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.